Hey there, it's Ryan Skaggs, and this is the Mortgage Minute. Thank you so much for tuning in. This channel is dedicated to everything mortgage, real estate, and specifically interest rates. So let's dive right in. The average 30-year fixed, it's mid-July 2021. The average 30-year fixed, 2.88. Check out that link below. I always link to Freddie Mac's weekly survey. Freddie Mac being one of the largest government-sponsored entities and buyer of mortgage-backed securities, has a great chart down there on their website that they continue to kind of be able to show you over the long-term, short-term, where rates have been moving. While you're down there, hit that like button, hit that subscribe button. I would be forever grateful. Click that bell icon to be notified as I put out weekly videos and then mortgage tips and explanation videos as well. So now let's dive into the topic this week, and that is a shortage on appraisal gap, a lot of different terminology. And what that essentially means is that you're going to use the example of, I'm going to buy a home for $500,000 and it does not appraise. The appraiser goes out and says, hey, based on these current comparables and other sales in the area, it's worth $475. And because of these inflated prices that we're seeing, that is an issue in especially a lot of resort, second home, warm climates, Arizona, Texas, Florida. We vacation down in Destin quite a bit, and I was looking at some homes that were bought in 2019 and 2020, for example, and I'll put some links below. But for example, they'll be bought just not more than a year or two ago, and looking at the pictures, I don't think they did anything. They would buy it for, say, $400 or $500, and it's for sale for $800 or $900. Almost double the amount of what they purchased it for inside of just a year or two because of such high demand. I can almost guarantee, I don't know those markets, nor do I have a Florida license, but with that said, I'd almost guarantee that that is an impossibility of being able to get an appraiser to be able to appraise it for that same value because the price is increasing so darn quickly. Now, what I want to do is I want to take you onto the screen of what happens. What do we do when that comes up? And in this first scenario, I gave you $500K purchase, and let's say the appraisal came in at 500, right? So that's this first column. When we say 500,000 at appraise, that's kind of our normal transaction. We got a cash to close around 105. Again, this is just for example purposes. Now, let's imagine it appraised for 475. Now, the seller's likely going to say, go pound sand. I don't care. You have to close, or you could cancel the transaction and we'll go find somebody else to pay this exact same amount. So in this case, we're going to write a loan based on 20% or the lesser of the appraised value or purchase price. So in this case, if you look at it, I've got a loan amount of 380. So if you take 475,000 times 0.8, you get 380,000. Okay, so that's where you get that loan amount of 380. So instead of having a loan amount of 400, now you have a loan of 380, and your cash to close went up by 20,000 bucks. So absolutely a low appraisal you can get away with if you're willing to bring more money to the table. You still pay 500, you still put up a loan amount of 380, so therefore you have a 20% loan to value, and off you go. Now in this next column, this third column here, lower price / split. In this case, you go to the seller and say, hey, it came in lower, but I'm willing to split the difference with you, seller, because we both know prices are super inflated. So why don't you come down $12,500 in your purchase price, and I'll put an extra $12,500 in to make sure that we come to the same, we can keep the terms of the contract moving forward. And in this case, you still got that 380 loan amount, right? If it was appraised at 475, if they're willing to come down in price, then you can get that as well. But with that said, you're essentially bringing in that difference, right? So that's where you've got scenario 3. Then on the far right column, you've got the same loan amount. Hey, in this scenario, I don't have an extra dollar to throw into this transaction. In that case, you still have a $400,000 loan amount, but you only have a $475,000 purchase. So basically, you have less than 20% down, and that's why this payment goes up slightly. So if you see here, 1632.96 in the left column and 1672.56 in the right column, we're essentially adding about $40 of mortgage insurance. This assumes someone with good credit. But my point would be is that you don't have to necessarily put more money in. you could take on mortgage insurance for a year or two at a very low amount monthly and be able to make the transaction work. So there really are a ton of scenarios. It's not going to sink your ship if the appraisal comes in low. Now, I will say in this market, in greater Chicagoland, North Shore, areas like Winnetka, Glencoe, Wilmette, Northbrook, Glenview that I'm at, that I focus on, I'm not seeing these issues. I'm not seeing these crazy issues. Now, the lower price point, absolutely, the $250,000 homes that are now $325,000, it's really hard for those properties to get there. But those higher priced homes in the Midwest and other places aren't appreciating like those crazy numbers like in California, Arizona, Texas, Florida. So that is the appraisal gap scenario. That's what happens. There's an example for you. Put your comments below. Thank you so much for tuning in. And this is the Mortgage Minute from Ryan Skaggs, and we'll see each other again very soon.